That's the problem. I mean, there's so many potential sort of scenarios that they're trying to put forward that all it's doing is creating uncertainty. So what's that leading to in the market? It's leading to a defensive, a risk-off. We've seen this sort of the stock markets overnight, shimmers of green, but predominantly in the red. Investors are very, very cautious at this stage, trying to sort of protect capital as they go into the second half of the year. But yes, you've got the midterms coming. There is this sort of assumption that Trump, as belligerent as he is in terms of his Make America Great Again and his protectionist policies, will perhaps try and pull back a little bit from the abyss as he gets closer, make himself
he's going after the autos, but at the end of the day, he needs those jobs in the United States.
At the end of the day, he needs the votes in the United States, and if he starts losing the jobs in the United States by being too protectionist, then he's going to shoot himself in the foot. So perhaps, he's trying to negotiate better terms for the US, of course, and this is his style in terms of his management of the economy. Fair enough. But the nearer we get to the midterms, one would suggest that he'll probably start to pull back a little bit just to try and protect his own position.
Simon, it's Nancy here in Singapore. Now, all this trade noise seems to be kind of clouding, if you will, for the moment, what would normally be attention on what's happening at the Federal Reserve here. The tightening environment underway, yet looking at what's happening to the U.S. 10-year yield, it's sitting at 2.8346. When you look at that spread narrowing with the 10-year and the 2-year, as an investor, are you worried about any cautionary tales this sends about U.S. growth going forward?
Well, it's not so much the US growth going forward, because I think if you look at the numbers for the economy, they're fairly strong, certainly from a jobs market perspective. But I think what that 2-10s curve down at 35 or sub 35 basis points now, as you say, the lowest since 2007. Again, it just underscores the level of defensive sentiment across the investor base that we're seeing around the globe at the moment as people plough into those defensive treasury assets. Longer term, 10 years, yes, that's been well underpinned, but the front end has been very, very well bid. And as you say, that flatter curve is a defensive reflection rather than a longer-term growth negative, I would suggest.
Yeah, and this defensive mood you're talking about, the change in risk appetite we've been tracking, hasn't been kind to some emerging markets. Today, we're looking in the Forex space at the Indian rupee at a record low, the rupiah having some trouble as well. Do you think there could be more pain to come for some of these emerging markets?
Well, in the short term, emerging markets will probably sort of find some stability if the 10-year holds sort of sub 290 and the 2s10s as flat as it is, as the hunt for yield returns or gains some momentum again during the summer. But the key thing to watch would be if Trump does sort of pull back from these sort of protectionist rhetorics, and we start to factor in that shift towards quantitative tightening from the Fed, that tectonic shift from asset allocation perspective in the second half of this year, then EM perhaps will start to underperform. But again, there are pockets of opportunity within the EM space, but you've got to be very much driven by underlying credit metrics, fundamentals, such as Bahrain earlier this month. We put a report out in early June, sort of battered but not broken, looking at the fundamentals there. Yes, a very sort of a bumpy fiscal road ahead for the economy, but at oversold levels it looked attractive. And of course, with the change in sort of GCC neighbour support from implicit towards explicit this week, we've seen a huge 200 basis point rally in CDS and a 7-point bounce in the bonds overnight. So it's those idiosyncratic opportunities that we need to be looking for now.